James Ashley, a senior economist at RBC Capital Markets and previously from the Bank of England. Thank you very much indeed for joining us today. Let's start in France. France has had a hard week on the markets. It was looking for something more positive from its GDP, wasn't it?
That's right, yeah. It certainly was. I think if you look at what's in the detail of the data, though, you see that domestic demand was actually broadly as expected. We had a weak private consumption number, but that's really due to special factors that happened in Q1.
Okay.
The real slowdown was really about the external side of the economy and exports being a bit weaker than expected. And to some extent, I think what we've seen in France, we might see replicated across the rest of the euro area economies as well next week.
That means, therefore, that we're looking at global demand falling off if France's export is lower. That's not something that looks like it's going to go away anytime soon, though, is it? I mean, that's going to be bad for France going forward. Certainly,
we are expecting a slowdown in growth from the fast pace that we had in Q1, and we do expect that to be a global feature. Certainly at RBC, we've downgraded our forecast relatively recently. We now expect euro area growth of just 0.3% on average for the next 2 quarters.
And so you're not going to change that after these figures came out from France today?
Absolutely not. The French numbers were a little bit weaker than expected, but in terms of the euro area number, we expected 0.3% next week. We still expect 0.3%, just that the risks have moved from the upside to a bit to the downside now.
Okay. If we look at Greece, there really was no optimistic take on what happened today. I mean, everything is contracting, and yet we're still seeing the GDP falling.
Yeah, I think you have to be careful with the Greek GDP numbers in the sense that the numbers that were published today were non-seasonally adjusted, and without getting too technical on this, it's very hard to back out anything meaningful out of those numbers. So I would treat that with a great deal of caution, but certainly the big picture is that the Greek economy is on for a significant contraction this year after a very significant contraction last year. So things are pretty grim in Greece still.
Is there any glimmer of hope on the horizon?
In the sense that we do expect growth to be stabilising towards the end of this year, and although we expected GDP contraction of around 4% in 2011, we are expecting broadly stable growth in 2012. So I wouldn't expect any great news in the near term, but looking towards the more medium-term numbers, we would expect to see some signs of improvement.
Okay. Well, I'd like to bring in now Joao Duque. He is Dean and Professor of Finance at ISEG in Lisbon and also advisor to the Portuguese Prime Minister. Thank you very much indeed for joining us from Lisbon today.
It's a pleasure.
We heard the Troika say that Portugal's plan to close its budget gap is credible. You must be very relieved to get that second tranche of money. Do you think the budget gap can be closed, or will you miss those once more?
No, you can't miss this opportunity, and I think actually everything is going under what is being forecasted and placed properly by the government. Actually, this was the first exam, and I think we've just passed the first exam. It was not very difficult to implement those first measures because they did not act into the cost side of the deficit. But so the expenses were not touched at least until the moment. But we think that we are implementing the measures that are needed in order to fully cover the program that was designed by the Troika.
Now, are you going to manage to cut this budget gap through cuts alone, or will you also have to raise taxes?
Well, we have been raising taxes for the last months, actually, and we have just heard from the Minister of Finance that VAT will be increased in this coming quarter, the last quarter of the year, in order to try to overcome some slice of the deficit. So actually, for the time being, the government is only increasing taxes, which has a strong impact on internal demand, and this has as an impact a strong reduction in imports. By the way, the best indicator that we have from May to the present moment is the exportations. They are strongly increasing, and this is a very good sign that at least in the economic side of the economy we are in the proper track, which means that sorting out the solution for the financial problem if the economy reacts according to is expected and is doing some signs that is reacting properly, it's a very good news, and I hope that we will overcome the problem.
James, are you as optimistic about Portugal's economy?
I certainly think the news out of today's report was broadly as expected. I think a more meaningful test will be what happens in the second review, which is due in November. I'm certainly not as negative on the Portuguese economy as I am on Greece, for example, but I do think that Portugal is probably on for contraction this year in the region of 2% and probably the same again next year. So there are significant challenges lying in the months and quarters ahead. But overall, I think Portugal is in shape and on course to meet those challenges.
Joe, we've seen in Greece the problems in trying to implement cuts because of the reaction of people there. Broadly speaking, Portugal's very different from that, for now at any rate, isn't it?
Actually, and the Troika actually recognizes that there is a big difference between Portugal and Greece. We have in Portugal both the government and the people all together feeling that we have this opportunity and we are strongly committed in order to take this opportunity into our hands and to sort out the problem. We think that we dig the hole, we are inside of the hole, but we want to come out all together. And this is very different from what is happening in Greece. They are doing what is being required, but they are not in the same mood of the Troika's request. So this is a very significant difference between both. We don't have strikes. People accommodated very reasonably the way how the government implemented a strong cut in our last salary of the year, because in Portugal salaries are paid 14 times a year, which means that the government decided to slice one of these salaries into a half, and everybody took that decision, which is one of the strongest decisions that I saw in my life being applied in Portugal by the government as a tax increase, and we have just accepted that, assuming that there is no way to overcome the problem unless we just do what is needed and we do it straight. So, and this is very different from what's happening in Greece. And even the parliament, we have a strong majority. Even the leader of the opposition, the party that is the Socialist Party that was in power before the last elections, they agree with the Troika. So we have three parties that sign up the memorandum of understanding.
Mr. Duque, we'll have to leave it there. I'm afraid we're running out of time. Thank you very much indeed for joining us from Lisbon.